Welcome back to the Daily Crypto Deep Dive. Today's deep dive is about Canton, a project that most retail crypto investors have never heard of, but one that has been quietly built for years to solve a problem traditional finance has struggled with since blockchain first appeared. Canton was publicly launched in 2023, following several years of private development, and was set up by Digital Asset in collaboration with major financial institutions and market infrastructure providers. From day one, Canton was never positioned as a retail blockchain or a speculative crypto project. It was designed specifically for banks, custodians, asset managers, and clearinghouses that needed blockchain technology without sacrificing privacy, regulatory compliance, or operational control. Canton was created to do something very specific: allow financial institutions to use blockchain to coordinate transactions across firms while keeping sensitive data private. Instead of forcing everyone onto one public ledger, Canton lets each institution run its own private ledger, and then synchronize transactions only when required. This design reflects how finance actually works in the real world, rather than how crypto enthusiasts wish it worked. Alongside the network, Canton introduced a native utility token called Canton Coin, commonly shown under the ticker CC. The token was not launched via a traditional ICO or retail-focused token sale. Instead, it was introduced as part of the network's operating model, intended to pay for network traffic and reward participants who provide real infrastructure and application utility. Canton Coin does not have a fixed maximum supply like Bitcoin, and its issuance is tied to network usage rather than speculative scarcity. Depending on market conditions, the circulating market value has at times placed Canton Coin in the mid-single-digit billions, but the project itself has never framed success around token price. From the beginning, Canton has been designed as financial infrastructure, not a hype-driven crypto asset. There are no flashy narratives, no influencer campaigns, and no promise of overnight wealth. Canton's goal is far more boring and far more ambitious, and their ambition is to become part of the invisible plumbing that allows regulated finance to move on to blockchain rails safely. And that's exactly why Canton matters. Canton is best understood as an institutional blockchain network designed for regulated finance. It is not a single public blockchain where all transactions are visible. Instead, it is a system that allows multiple institutions to operate their own private ledgers while still being able to coordinate and settle transactions together when required. This is a crucial distinction. In public blockchains, transparency is the feature. Everyone sees everything. That works perfectly for open networks and retail users. It does not work for banks managing sensitive client data, proprietary trading strategies, or regulated financial workflows. Institutions cannot broadcast their internal activity to the world, and regulators do not require them to. Before Canton, institutions had two flawed options. They could use public blockchains and accept massive privacy and compliance risks, or they could build private blockchains that worked internally but could not easily interact with other systems. The result was fragmentation, inefficiency, and duplicated infrastructure. Each participant on Canton runs its own ledger and controls its own data. Nothing is shared by default. When a transaction requires coordination between multiple parties, only the minimum necessary data is synchronized, and only between the parties involved. There is no global mempool. There is no full transaction broadcast. There is no requirement to expose internal operations to the wider network. At the heart of this design is what Canton refers to as the global synchronizer. The synchronizer ensures that transactions involving multiple ledgers settle atomically. Either every part of the transaction completes, or none of it does. In financial markets, this matters more than almost anything else. Partial settlement creates risk. Atomic settlement reduces it. This architecture mirrors how real financial systems already work, but automates the coordination layer using blockchain technology. Canton is closely associated with Digital Asset, a blockchain infrastructure company that has spent over a decade working directly with financial institutions. Digital Asset is best known for creating DAML, a smart contract language designed to represent real financial agreements rather than retail DeFi abstractions. DAML emphasizes permissioning, determinism, and legal clarity, which are exactly the characteristics institutions require. Canton applications are built using DAML, which immediately tells you who this system is designed for. This is not infrastructure built for influencers or retail traders. It is infrastructure built for banks, custodians, clearinghouses, and market infrastructure providers. As a result, Canton's adoption looks very different from typical crypto projects. You do not see marketing campaigns, token hype, or retail narratives. Instead, you see institutions using Canton for tokenized bonds, collateral management, repo transactions, fund administration, and settlement workflows. These are core financial processes, not experiments. Now we need to address the part that causes the most confusion: the token. Canton does have a native token called Canton Coin. It is often shown under the ticker CC on exchanges and data platforms. But Canton Coin is not designed like a typical crypto token. And misunderstanding this is where most commentary goes wrong. Canton Coin is positioned as a utility token. Its role is to support the operation of the network, rather than to act as a speculative asset. It is used to pay for network traffic and synchronization services, and it is used to reward participants who provide real infrastructure and application utility to the network. Canton Coin was not launched through a traditional retail token sale. There was no large public ICO. There was no standard venture capital pre-allocation structure that dominates much of crypto. The stated design goal was that tokens enter circulation primarily through participation and contribution, rather than early financial engineering. Participants who run infrastructure, support synchronization, or operate applications that generate network activity can earn Canton Coin. This aligns incentives around actual usage rather than passive holding. At the same time, Canton Coin is tradable on exchanges, meaning it can be bought and sold by the market. But trading is not the core purpose of the token. It is important to be precise about supply, because Canton Coin does not follow the familiar fixed max supply model. There is no hard cap like Bitcoin. Instead, Canton uses a dynamic supply model tied to network usage. Tokens can be minted as rewards for contribution and burned when used for network fees. The intention is to balance issuance with real economic activity, rather than enforce artificial scarcity. That means traditional metrics, like fully diluted valuation, are less meaningful here than they are for retail-focused blockchains. This is infrastructure economics, not meme economics. This also explains why Canton feels invisible to much of crypto Twitter. There is no simple price narrative. There is no obvious retail upside story. There is no influencer incentive to talk about it. Canton is designed to be boring, slow, regulated, and reliable. And that is exactly why institutions trust it. The bigger picture here matters. Canton represents a version of blockchain adoption that looks nothing like the retail crypto cycles people are used to. It is quiet. It is incremental. It is compliance first. It moves carefully because the stakes are real. Public blockchains may continue to dominate open finance, experimentation, and retail innovation. But the bulk of traditional finance is not moving onto fully public rails overnight. Instead, it is adopting blockchain principles in controlled environments first. Canton sits directly in that transition layer. Over time, the private institutional world and the public crypto world are likely to connect. When that happens, infrastructure like this becomes extremely important, even if it never becomes popular. For retail investors, Canton is not a simple, buy this and get rich story, and that's important to say up front. There is no hype-driven roadmap, no aggressive marketing, and no guarantee that owning the token directly benefits from institutional adoption in the way people are used to with retail blockchains. What Canton offers instead is something more subtle but more important. A window into how traditional finance is actually adopting blockchain. If Canton succeeds, it doesn't mean retail investors suddenly make outsized gains overnight. It means blockchain becomes embedded into the financial system quietly, legally, and at scale. For retail, the value is not in speculation, but in understanding direction. Canton helps you see where the real money is positioning, what kind of infrastructure banks are willing to trust, and how the next phase of crypto adoption is likely to look. That context alone can be valuable, because retail is usually late. And Canton shows you what institutions care about long before the headlines catch up. Thanks again for listening, and as always, we will see you at the top.